So the way that markets make the most exciting up moves is through a process called a slingshot. And basically think of it this way. It is like pulling back on a slingshot. The further you pull back, the more distance that projectile will ultimately attain. So when we're looking at a financial market instrument like the stock market, how you create a slingshot is through something called a false move, which is like a crash um, down, and then the energy released to the upside causes the market to quickly recover the loss and make a move to new highs. So we have two examples in the 2007, 2009 slingshot. You were basically looking at about a 2 year decline in the Dow. And then once it bottomed, it took 65 months to recover and make new highs. Obviously, if people sold the high in 2007 and bought the low in 2009, they made a lot of money very quickly. In the case of 1987, the slingshot took place in a more confined space. So it was a 3 day decline of about 40%. And then the decline was followed by new highs within 24 months. Of course, this is even far more dramatic for people who sold the high and went short, or who sold the high and held the cash until the low came and bought the low. So think of a slingshot as basically it's like a deke or a fake out move that markets will go through to trap people. And if you can get these slingshot moves correct, they're incredibly profitable. And the best way to get a slingshot move correct is to sell the high and either short into the low and then buy the low, or to sell the high, hold the cash, and then buy the low. Either way, you're going to make a lot of money on the coming slingshot, which will be impacting markets between 2026 and 2028.